Welcome once again to our commerce classroom. In this session, we will discuss about revenue from contracts with customers. Ind AS 115. Revenue from contracts with the customers. Here we start our discussion by explaining certain terms. Revenue. Revenue is the income arising in the ordinary course of an entity's activities. Revenue may be called by different names such as sales, fees, interest, dividend, royalties, etc. But revenue doesn't include taxes, GST, etc. The reason, taxes and GST collected for government. It doesn't give any economic benefit to the business entity. Then second term we discuss here is contract. We know contract is an agreement between two or more parties that creates enforceable rights and obligations. I repeat, contract is an agreement between two or more parties that creates enforceable rights and obligations. Then the third term we discuss here is customer. Customer is a party that has contracted with an entity to obtain goods or services that are an output of entity's ordinary activities in exchange for consideration. I repeat, a customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. And the fourth term we discuss here is income. Income means increases in economic benefit during the accounting period in the form of inflows or enhancements of assets or decreases in liabilities that result in an increase in equity other than those relating to contributions from equity participants. I repeat, income means increases in economic benefit during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in an increase in equity other than those relating to contributions from equity participants. Then we discuss about objectives of Ind AS 115. Objectives of Ind AS 115. The objective of this standard is to establish the principles that an it shall apply to report useful information to the users of financial statements about the nature, amount, timing and uncertainty of revenue and cash flows arising from a contract with a customer. I repeat, the objective of this standard is to establish the principles that an entity shall apply to report useful information to the users of financial statements about the nature, amount, timing and uncertainty of revenue and cash flows arising from a contract with a customer. Then the scope of Ind AS 115. An entity shall apply this standard to all contracts with the customers except the following. First, lease contracts within the scope of Ind AS 17. Second, insurance contracts within the scope of Ind AS 104. And third, financial instruments and other contractual rights or obligations within the scope of Ind AS 109. Then fourth, financial instruments Ind AS 110. And then fifth, consolidated financial statements Ind AS 111. And then sixth one, joint arrangements Ind AS 27. And seven, separate financial statements and Ind AS 28. Investments in associates and joint ventures and non-monetary exchanges between entities in the same line of business to facilitate sales to customers or potential customers. For example, this standard would not apply to a contract between two oil companies that agrees to an exchange of oil to fulfill demand from their customers in different specified locations on a timely basis. Then we discuss about revenue recognition and measurement under Ind AS 115. Revenue should be recognized when an entity transfers control of goods or services to the customer at the amount to which the entity expects to be entitled. Ind AS 115, IFRS 15 establishes a 5-step model that entities would need to apply to determine when to recognize revenue and to what amount. 5-step model. First step, identify the contract. Second step, identify performance obligations in the contract. And then third step, determine transaction price. And then fourth step, allocate transaction price to the performance obligations. And the last and fifth step, recognize revenue when the entity satisfies its performance obligations. I repeat, 5-step model. First step, identify the contract. Second step, identify performance obligations in the contract. And the third step, determine transaction price. And the fourth step, allocate the transaction price to the performance obligations. And the last step, recognize revenue when the entity satisfies its performance obligations. Then we discuss about all these 5 steps in detail. First step, identify the contract. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations. Enforceability of the rights and obligations in a contract is a matter of law. Contracts can be written, oral or implied by entities' customary business practices. An entity shall account for a contract with a customer that is within the scope of the standard only when all of the following criteria are met. Then we discuss about the criteria to be met. First criteria, the parties to the contract have approved the contract and are committed to perform their respective obligations. First criteria, the parties to the contract have approved the contract and are committed to perform their respective obligations. Second criteria, the entity can identify each party's rights regarding the goods or services to be transferred. Second criteria, the entity can identify each party's rights regarding the goods or services to be transferred. And the third criteria, the entity can identify the payment terms for the goods or services to be transferred. Third criteria, the entity can identify the payment terms for the goods or services to be transferred. And the fourth criteria, the contract has commercial substance, that is, the risk, timing or amount of entity's future cash flows is expected to change as a result of the contract. And the last criteria, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. I repeat the last criteria, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. These are the criteria to be observed. Then the second step, identifying performance obligations. A contract with a customer generally states the goods or services that an entity promises to transfer to a customer. Such promises are called performance obligations. I repeat, a contract with a customer generally states the goods or services that an entity promises to transfer to the customer. Such promises are called performance obligations. An entity would account for performance obligations separately only if the promised goods are distinct. A goods or service is distinct if it is sold separately because it has a distinct function and distinct profit. I repeat, an entity would account for performance obligations separately only if the promised goods are distinct. A goods or service is distinct if it is sold separately because it has a distinct function and a distinct profit. Then we discuss about promised goods or services. Depending on the contract, promised goods or services may include the following. First item, sale of goods produced by an entity, for example, inventory of a manufacturer. Second item, resale of goods purchased by an entity, example, merchandise of a retailer. Third item, resale of rights to goods or services purchased by an entity, for example, a ticket resold by an entity acting as a principal. And the fourth item included performing a contractually agreed upon task for a customer. And the fifth item, providing a service of standing ready to provide goods or services, or of making goods or services available for a customer to use as and when the customer decides. And the next item, providing a service of arranging for another party to transfer goods or services to the customer. And another item, granting rights to goods or services to be provided in future that a customer can resell or provide to its customer. And another item, constructing, manufacturing or developing an asset on behalf of a customer, then granting licenses. And the last item, granting options to purchase additional goods or services. These are the items to be included in promised goods or services. Then we discuss about satisfaction of performance obligations. An entity shall recognize revenue when the entity satisfies a performance obligation by transferring a promised goods or services to a customer. An asset is transferred when the customer obtains control of that asset. I repeat, satisfaction of performance obligation. An entity shall recognize revenue when the entity satisfies a performance obligation by transferring promised goods or services to a customer. An asset is transferred when the customer obtains control of that asset. Then methods of measuring progress towards complete satisfaction of a performance obligation. I repeat, methods of measuring progress towards complete satisfaction of a performance obligation. Appropriate methods of measuring progress include input methods and output methods. Here, input methods based on resources consumed, labor hours, cost incurred, time elapsed or machine hours used, and output methods based on units produced or units delivered. Then, performance obligation can be satisfied in two ways. There are two ways for satisfying performance obligation. First one, recognize revenue over the period of time. Second one, recognize revenue at the point of time. When the performance obligation is satisfied, the entity shall recognize the amount of transaction price as revenue that is allocated to that performance obligation. I repeat, when the performance obligation is satisfied, the entity shall recognize the amount of transaction price as revenue that is allocated to that performance obligation. Then the third step, determine the transaction price. An entity shall consider the terms of contract and its customary business practices to determine the transaction price. The transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, for example, some sale tax. I repeat, the transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties, example, sale taxes. The consideration promised in a contract with a customer may include fixed amounts, variable amounts, or both. I repeat, the consideration promised in a contract with a customer may include fixed amounts, variable amounts, or both. When determining the transaction price, an entity shall consider the effects of all of the following. First one, variable consideration. Second one, constraining estimates of variable consideration. Third one, the existence of a significant financing component in the contract. Then fourth one, non-cash consideration. And the fifth one, consideration payable to a customer. I repeat, when determining transaction price, an entity shall consider the effects of all of the following. First one, variable consideration. Second one, constraining estimates of variable consideration. Then third one, existence of a significant financing component in the contract. Then fourth one, non-cash consideration. And the fifth one, consideration payable to a customer. Then we discuss about all these five in detail. First one, variable consideration. If the consideration promised in a contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange for transferring the promised goods or services to a customer. An amount of consideration can vary because of discounts, rebates, refunds, credits, purchase concessions, incentives, performance bonuses, or other similar items. I repeat, variable consideration. If the consideration promised in a contract includes a variable amount, An entity shall estimate the amount of consideration to which the entity will be entitled in exchange for transferring the promised goods or services to a customer. An amount of consideration can vary because of discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, or other similar items. An entity shall estimate an amount of variable consideration by using either of the following two methods. First one, the expected value, or second one, the most likely amount. Then firstly, the expected value. The expected value is the sum of probability weighted amounts in a range of possible consideration amounts. An expected value may be an appropriate estimate of the amount of variable consideration if an entity has a large number of contracts with similar characteristics. Then secondly, the most likely amount. The most likely amount is the single most likely amount in a range of possible consideration amounts. The most likely amount may be an appropriate estimate of the amount of variable consideration if the contract has only two possible outcomes. For example, an entity either achieves a performance bonus or doesn't. Then we discuss about refund liabilities. An entity shall recognize a refund liability if the entity receives consideration from a customer and expects to refund some or all of that consideration to the customer. And the third term, constraining estimates of variable consideration. Constraining estimates of variable consideration. An entity shall include in the transaction price some or all of the amount of variable consideration estimated only to the extent that it is highly probable and will not result in a significant revenue reversal. And fourth term, the existence of significant financing component in a contract. In determining the transaction price, an entity shall adjust the promised amount of consideration for the effects of the time value of money. I repeat, in determining the transaction price, an entity shall adjust the promised amount of consideration for the effects of the time value of money. An entity shall present the effects of financing, here interest revenue or interest expense, separately from revenue from contracts with customers in the statement of profit and loss account. And another term, non-cash consideration. To determine the transaction price for contracts in which a customer promises consideration in a form other than cash, an entity shall measure the non-cash consideration or promise of non-cash consideration at fair value. I repeat, to determine the transaction price for contracts in which a customer promises consideration in a form other than cash, an entity shall measure the non-cash consideration at fair value. If an entity cannot reasonably estimate the fair value of the non-cash consideration, the entity shall measure the consideration indirectly by reference to the standalone selling price of the goods or services promised to the customer in exchange for the consideration. Then, consideration payable to a customer. Consideration payable to a customer includes cash amounts that an entity pays or expects to pay to the customer. I repeat, consideration payable to a customer include cash amounts that an entity pays or expects to pay to the customer. Consideration payable to a customer also include credit or other, for example, coupon or voucher, that can be applied against amounts owed to the entity. An entity shall account for consideration payable to a customer as a reduction of the transaction price. Then the fourth step. Allocating the transaction price to performance obligations. To meet the allocation objective, an entity shall allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis of each performance obligation in the contract. I repeat, to meet the allocation objective, an entity shall allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis of each performance obligation in the contract. A standalone selling price is the observable price of a goods or service when the entity sells that goods or service separately in similar circumstances and to similar customers. If a standalone selling price is not directly observable, an entity shall estimate the standalone selling price. allocation of discount, allocate discount proportionately to all performance obligations in the contract. Then change in the transaction price. An entity shall allocate to the performance obligation in a contract any subsequent changes in the transaction price on the same basis as at contract inception. Then our last step, recognize revenue. Revenue is recognized when the entity satisfies performance obligation. I repeat, revenue is recognized when the entity satisfies performance obligation. An entity satisfies performance obligation by transferring the promised goods or services, here assets, to the customer. An asset is transferred when the customer obtains control of that asset. I repeat, an asset is transferred when the customer obtains control of that asset. Then the amount of revenue recognized is the amount allocated to that performance obligation. A performance obligation can be satisfied at a point in time or over a period of time. I repeat, the amount of revenue recognized is the amount allocated to that performance obligation. A performance obligation can be satisfied at a point in time or over a period of time. A performance obligation is said to be satisfied over a period of time if one of the following criteria is met. I repeat, a performance obligation is said to be satisfied over a period of time if one of the following criteria is met. First one, the customer simultaneously receives and consumes the benefits as the performance takes place. I repeat, the customer simultaneously receives and consumes the benefits as the performance takes place. Secondly, the entity's performance creates or enhances an asset that the customer controls. And the third point, the entities of performance doesn't create an asset with an alternative use to the entity. And the fourth point, the entity has enforceable right to receive payment for the performance completed to date. Example, asset built to order. These are all about our Ind AS 115. I think this session is clear for all of you. We will meet again. Till then, goodbye.